Welcome to vTalkInsight, Risk Sentiment Daily for February 26, 2026. AI earnings are pulling equities higher even as credit and geopolitics quietly load more risk into the tails. Let's unpack how that tension is shaping today's market mood. Risk sentiment today looks cautiously bullish rather than exuberant. U.S. equities have pushed higher, while implied volatility has slipped back below the levels seen earlier this month, and global commentary points to a market that expects choppy trading but still assumes that dips will be met with buying interest. Across regions, investors describe an environment where indices can correct, sectors can rotate sharply, yet the underlying macro picture and earnings trajectory are strong enough that pullbacks are viewed as opportunities rather than the start of a prolonged downturn. Under the surface, this optimism is tempered by significant hedging and dispersion. Single stock volatility is running well above index volatility. Downside protection costs are above average on both recent and longer-term comparisons, and options markets in technology and energy show pronounced demand for insurance against adverse shocks. So the tape looks healthy on the surface, yet positioning and derivatives pricing reveal a market that wants to stay invested in the growth story while still paying up to guard against outsized left-tail events. Putting it together, the overall tone is of a market that believes in a soft landing and robust earnings, but is acutely aware of fragile pockets in credit, AI-exposed sectors, and geopolitics. That balance keeps the bias mildly risk-on, with investors rotating capital rather than exiting wholesale, and using hedges and safe havens rather than abandoning the equity and credit complex. Against that backdrop, the main drivers of today's sentiment are the soft landing macro and earnings strength, the AI infrastructure boom led by Nvidia, a broadening of equity leadership beyond mega-cap tech, and on the other side of the ledger, growing concern around an AI bubble, credit vulnerabilities, and persistent trade and geopolitical tensions. Soft landing macro and earnings strength are anchoring the bullish case. Forecasts for U.S. real growth around the mid-2% range next year, alongside inflation gradually converging towards central bank targets, point to an environment where activity remains solid without forcing an aggressive tightening response. Wage growth above 3% and strong industrial indicators suggest demand is still there, while disinflation pressures from goods and selective sectors help keep policymakers comfortable with a slower, more measured path. On the corporate side, the earnings picture looks surprisingly resilient. Expectations for double-digit profit growth, with recent data showing around 12% earnings expansion and improving industrial activity, give investors confidence that equity valuations can be supported even if multiples stop expanding. Banks in Europe, exemplified by strong results and upgraded guidance from a major global lender, and select consumer and restaurant names posting robust sales and optimistic outlooks, are reinforcing the message that profits are not confined to a narrow slice of the market. This combination leads many investors to frame volatility as noise around a constructive baseline rather than a regime change. Pullbacks are expected as sector leadership rotates and as AI-related disruption hits specific industries, but the core view is that earnings and macro data should keep broad indices biased upward over the coming year. The key watch points are whether forecast growth in the 2 to 3% range materializes and whether profit margins can stay firm as wage gains and input costs evolve, because any disappointment there would weaken this soft landing pillar quickly. The AI infrastructure boom and Nvidia's strength are a second major support for risk appetite. Large cloud and internet platforms have effectively doubled their expected capital spending growth for the year, moving from roughly 30% plans to closer to 60%, translating into AI-focused budgets in the mid-hundreds of billions of dollars. Debt issuance from these names is projected to exceed $700 billion as they fund this build-out, underscoring the sheer scale of resources being directed into data centers, networking, and high-performance compute. Nvidia sits at the center of this cycle, and its latest update has reinforced that leadership. Management guided quarterly revenues well above earlier market expectations, with a range in the high $70 billion area compared with consensus that was several billion lower, and maintained robust gross margin guidance in mid-70s, despite memory suppliers enjoying their strongest pricing leverage in a decade. Data center revenues are on track to reach around $60 billion this quarter. Demand for its chips continues to exceed supply. Rental prices for older generations remain elevated, and the company has secured key component supply, all of which point to strong visibility into a substantial forward order book. Beyond Nvidia itself, the AI cycle increasingly looks structural rather than purely speculative. The infrastructure build-out is being underpinned by long-term contracts with sovereigns and large enterprises. Demand for AI data centers is running ahead of what can currently be delivered, and a recent survey suggests AI-related investment is now contributing more to real GDP growth than information technology did at the height of the dot-com era. That backdrop supports not just semiconductors, but also industrials, utilities, and materials linked to power, cooling, and construction, although markets are also asking harder questions about when this wave of Capex will translate into profits for end users and whether growth rates of 60 to 70% can be sustained as the base gets larger. Broadening equity leadership beyond mega-cap tech is another constructive theme for risk sentiment. After a long period where a handful of AI-exposed giants dominated returns, recent performance shows notable strength in asset-heavy sectors such as energy, industrials, and selected consumer staples, with these areas in some cases outperforming traditional growth leaders by a wide margin. Investors are deliberately favoring businesses with tangible assets and more visible cash flows as a partial hedge against disruption risk in software and other asset-light models, and that shift is helping to diversify the drivers of index-level returns. Geographically, the breadth story is similar. Equity indices in markets such as parts of Asia and Latin America have delivered gains that far exceed those of some U.S. benchmarks over the past year, helped by currency moves, domestic policy, and less stretched starting valuations. Within the U.S., leadership has also broadened as investors rotate into industrials, materials, and utilities that benefit indirectly from AI infrastructure spending, while consumer staples and middle-income-facing sectors have been supported by tax refunds and steady demand for affordable luxuries. Set against those positives, AI bubble fears and tech fragility are becoming a dominant bearish driver. Investor surveys now cite an AI-driven bubble as the single biggest market risk, with nearly a quarter of respondents naming it as their primary concern, reflecting anxiety that valuations in key AI and software franchises may have moved ahead of fundamentals. Options markets confirm the caution, with downside skew in technology-related exchange-traded funds at levels last associated with major stress episodes, indicating that many investors are happy to own the upside but are paying up aggressively to protect against sharp drawdowns. Price action in software illustrates this fragility. The main software index has fallen around 30% from recent highs, and several high-profile enterprise names have seen growth slow from the high teens into the low double digits, triggering significant multiple compression as investors reassess how exposed legacy products are to AI disruption. Some companies now trade at or even below pre-pandemic revenue and earnings multiples, which suggests a substantial amount of skepticism is already embedded, yet the sector remains volatile as the market struggles to separate entrenched platforms from smaller, less diversified players that could be more easily displaced. Nvidia itself is not immune to these worries. While the company is delivering exceptional growth and maintaining a clear technological lead, there is active debate about how long revenue can expand at 60 to 70% rates and whether today's roughly 40 times forward earnings valuation already discounts much of the good news. Some observers argue that recent rallies in AI leaders have tended to fade even after strong reports, which raises the risk that future earnings beats spark more muted price reactions, and that any disappointment on guidance or free cash flow could have an outsized impact on index-level sentiment, given how central these names have become. Rising private credit and spread risks form another important bearish undercurrent. Analysts have lifted their forecasts for private credit default rates toward the mid-teens, up meaningfully in just a month, with AI-related disruption cited as a key threat to the cash flows of leveraged borrowers in vulnerable sectors. Recent asset sales at discounts and fund closures in parts of the private credit ecosystem are drawing uncomfortable comparisons with the period before the global financial crisis, especially where structures involve asset-liability mismatches or semi-liquid products offered to retail investors. Public credit markets also show signs of complacency. High-yield defaults have been running near 6% for 2 years, signaling ongoing stress. Yet option-adjusted spreads sit close to historic lows around 300 basis points, leaving limited room for further tightening and raising the risk of outsized widening moves if conditions deteriorate. Business development companies are trading at discounts with double-digit yields, indicating investors are demanding a liquidity premium, while institutional investors in leveraged loans and collateralized loan obligations report that recent volatility has created opportunities, but also highlights the need to be selective on structure and underlying asset quality. The AI investment boom feeds into this story through funding channels. Traditionally cash-rich technology companies are tapping bond markets at scale to finance AI infrastructure, pushing projected tech-related issuance above $700 billion this year and raising the prospect that supply could start to overwhelm demand in some segments. As a result, investors expect their bargaining power to improve, with higher required yields and tighter covenants, and there is growing concern about banks' indirect exposure through lending to private credit vehicles and business development companies, which could create feedback loops if defaults rise or liquidity dries up. Escalating trade and geopolitical tensions round out the main bearish drivers. In the U.S., the administration is signaling higher baseline tariff rates on selected imports, with plans to lift some levies from 10 to 15% and to use trade investigation mechanisms more aggressively against countries accused of unfair practices. Legal complexity around the authorities being used and the prospect of challenges from trading partners create uncertainty for globally exposed companies, particularly in consumer, industrial, and apparel segments that are sensitive to landed cost changes and supply chain rerouting. In parallel, geopolitical strains remain elevated. Rising tensions over Iran's nuclear program and explicit concern from U.S. officials have nudged oil prices higher and pushed options markets into extreme territory, with downside protection in risk assets and upside call interest in energy reaching levels last seen during prior crises. Gold allocations have outperformed expectations, supported not only by inflation worries, but also by central bank diversification and persistent geopolitical risks, which together sustain a structural bid for perceived safe havens even when headline equity indices appear calm. Regulatory and regional developments add further layers. Pressure from defense establishments on leading AI labs to accommodate military use, ongoing support for Ukraine financing despite internal European tensions, and questions around the longevity of existing trade agreements, such as regional North American pacts, all contribute to a more fragmented policy landscape. So far, markets have largely looked through individual flare-ups, but option markets, safe haven flows, and corporate behavior suggest that these risks are increasingly being priced as a semi-permanent backdrop rather than a series of one-off events. To wrap up, today's risk tone is cautiously bullish. A soft landing macro backdrop, resilient earnings, and a powerful AI infrastructure boom are keeping investors engaged in equities, while leadership gradually broadens beyond a narrow group of mega-cap tech names. Set against that, AI bubble concerns, emerging stress in private credit and tightly priced spreads, and a more confrontational trade and geopolitical backdrop are all adding weight to the tails, which is showing up in heavy hedging, safe haven demand, and persistent dispersion beneath calm index levels. Watching how Nvidia and the wider AI complex convert Capex into cash flows, how credit markets absorb continued issuance, and how trade and geopolitical headlines evolve will be critical for understanding whether this cautiously positive equilibrium can hold. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.